The stock market is officially closed today, Saturday, June 20, 2026. So we are looking at the final numbers from the last active trading session on Thursday, June 18, 2026, because the market remained closed on Friday for the federal Juneteenth holiday. Nuburu Inc., trading under the ticker symbol BURU on the NYSE American exchange, finished that last session at exactly 16 cents, down 2.08% on the day. The stock opened at 16 cents, hit an intraday high of 16.5 cents, and touched a low of 15 cents, all while trading on a massive volume of 25 million shares. This volume is staggering when you realize this is a microcap company with a total market valuation hovering right around $29 million. While the headline numbers show a cheap stock drifting downward, what most people are missing is the aggressive corporate restructuring going on behind the scenes that completely changes how we view this company. Investors look at a 16-cent stock and assume it is on the verge of bankruptcy, but a deeper look at their fresh first quarter financial statement reveals they pulled off a dramatic balance sheet recovery, swinging from a $15 million equity deficit at the end of last year to a positive equity position of over $2 million. This sudden financial turnaround is a piece of information that creates a significant disconnect between what the average retail trader assumes and what the actual balance sheet is showing. The common belief surrounding Nuburu is that it is just another high-risk penny stock bound to face delisting or continuous dilution, a speculative bet that belongs on high-risk trading platforms rather than a stable individual brokerage account. When people look at the long-term price chart, which shows a steep decline from its previous highs, they group it together with failed tech startups. The general expectation is that a business trading at this price level lacks real commercial demand and cannot secure high-value contracts. This assumption causes many institutional managers and conservative investors who use Schwalm Intelligent Portfolios or traditional portfolio strategies to completely ignore it. The reality, however, is that this tiny firm is aggressively pivoting into the national defense and critical infrastructure markets, areas where spending is virtually guaranteed by government budgets. Instead of just trying to sell industrial hardware to cash-strapped factories, they are positioning their high-power blue laser technology directly inside military supply chains. They recently signed a definitive agreement to acquire a 70% stake in an Italian defense firm named Tekne, valuing that business at 52 million euros and outlining a $336 million defense plan running through 2029. This means a company valued at under $30 million in the public markets is trying to absorb an international defense operator twice its size. This bold move has completely upended the expectation that the firm would quietly fade away. This tension between what the market expects and what the company is executing explains the intense trading volume we have seen lately. Over 45 million shares traded on a single Wednesday earlier this month when the stock shot up over 14%. When you see retail investors on a Robinhood app or using Robinhood stock trading features chasing these massive daily swings, they are often trading on short-term technical indicators. But sophisticated traders executing orders on an interactive broker's platform or managing substantial accounts via Fidelity investments are looking at the legal filings. They are tracking the progress of Italy's Golden Power Framework Review, which is the official government process required to clear this majority acquisition. If you look at the broader market, investors routinely allocate their capital to tech giants, poured over from tracking Tesla stock, Apple stock, or Nvidia stock to see where the next big technological shift will happen. While those trillion-dollar firms dominate the headlines and take up the majority of space in popular Fidelity ETFs and Fidelity mutual funds, small-cap industrial technology is where massive valuation anomalies actually occur. When an investor decides to move away from prepackaged portfolios like a SoFi robo-advisor and takes up active self-investing, they start looking for companies where a single contract win can double or triple the firm's underlying value. That is exactly the situation playing out with this blue laser manufacturer. The daily trading patterns reveal an asset that is highly sensitive to press releases and regulatory milestones. When the company announced they filed the formal Golden Power notification with the Italian government, the stock experienced intense volatility as short sellers and momentum traders collided. Institutional activity remains low due to the low stock price, meaning the order book on the Fidelity trading platform or interactive broker stock trading screens is driven mostly by private investors and specialized microcap funds. This lack of institutional stability means retail traders on a Robinhood mobile application can easily cause 15% daily swings just by reacting to a single piece of news. To understand why this price action is so volatile, we have to look closely at what the business actually does. The company manufactures industrial blue lasers, which operate at a specific wavelength that allows metals like copper, aluminum, and gold to absorb the energy much more efficiently than traditional infrared lasers. This efficiency is critical for manufacturing electric vehicle batteries, aerospace components, and consumer electronics, where precision welding is mandatory. If you are welding copper with a standard laser, the metal reflects most of the light, leading to defects, but blue light is absorbed rapidly, creating clean, high-speed welds. Their business model revolves around selling these specialized laser engines, named the AO and the Orbit, to industrial manufacturers and defense contractors. Looking back at their older reports, the company struggled significantly with commercial scaling. They burned through substantial cash, which led to the compliance notices from the NYSE American exchange regarding their low stockholders' equity. For a long time, the reality fell short of expectations, as the company had the academic proof of their technology, but lacked the commercial orders to sustain operations. This history of poor performance is why the stock is priced where it is today. Investors who lost capital during the initial decline are hesitant to return, keeping the valuation suppressed even as the fundamental situation begins to change. Recently, the strategy shifted dramatically towards defense and security applications. They expanded their roadmap to focus on directed energy applications and counter-drone initiatives, partnering with Maddox Defense to build funded prototypes for military demonstrations. This puts them square in the middle of the rapidly growing counter-unmanned aerial systems market, which is a major priority for defense spending globally. They also secured a $1 million order from a Tier 1 critical infrastructure customer for their Orbit laser system, showing that commercial traction is finally beginning to appear on the horizon. Please comment below with the specific name of the platform you use for your microcap trades, whether it is SoFi Invest, a traditional Fidelity brokerage account, or something else, and let me know how many shares of this stock you are currently tracking in your portfolio. Getting a sense of where everyone is executing these trades helps understand how retail capital is flowing into these high volatility names. When we map out the future outlook for this business, two distinct scenarios emerge based on the expectation versus reality framework. The optimistic path relies entirely on the successful closure of the Tekne acquisition and the execution of that $336 million Italian defense plan. If the Italian government approves the transaction under their regulatory review, this company will instantly transform from a struggling industrial laser component maker into an integrated defense contractor with established revenue streams and international government relationships. This would completely invalidate the bearish expectation that the company will run out of cash, forcing a massive re-rating of the stock price that would catch many short sellers off guard. The pessimistic scenario, which keeps conservative investors using online investing sites cautious, is the constant threat of capital dilution and regulatory rejection. If the Italian government blocks the acquisition, or if the defense contracts take years to materialize, the company will be forced to raise additional capital by issuing more shares. For a retail investor holding fractional shares on a Robinhood app, this dilution eats away at their position value. Furthermore, maintaining compliance with exchange listing rules remains a constant operational hurdle when your stock trades under $1. The management has to maintain positive equity and eventually lift the share price to avoid being pushed to the over-the-counter markets. This creates a fascinating setup for individuals managing their own self-investing strategies through an individual brokerage account. On one side, you have a historical narrative of a company that failed to scale its industrial business, leading to a severely depressed stock price. On the other side, you have an aggressive management team executing a high-stakes pivot into the global defense industry, backed by an improvement in their latest quarterly equity balance. The market is currently pricing this asset as if failure is guaranteed, which means any positive operational reality will exceed those low expectations. For anyone looking for investment help or analyzing this through sophisticated investing sites, the core lesson here is about tracking structural changes rather than just past price movement. While popular discussions often center on whether to hold a major index fund, a Fidelity IRA, or a diversified intelligent portfolio, looking at individual microcaps requires analyzing geopolitical approvals and defense contract pipelines. The volatility we are witnessing on the Interactive Brokers platform isn't just random noise. It is the market attempting to price a complex corporate transformation in real time. To summarize the central insights of this analysis, the stock remains a high-stakes battleground where short-term trading volumes reflect deep uncertainty about its long-term survival. The expectation is that the low share price reflects a dying business model, while the emerging reality shows an active pivot into defense infrastructure and an improved balance sheet. The massive gap between these two perspectives is exactly what is driving the wild double-digit swings during active market sessions. Whether this corporate pivot succeeds or fails depends entirely on international regulatory approvals and upcoming military contract milestones, making it an essential ticker to monitor for anyone interested in high-risk, high-reward industrial technology.